two-day Fed meeting kicks off later this week. Bets on a rate hike have receded quite a bit in the last few weeks after key members of the Federal Open Market Committee, or FOMC, have advocated a pause, at least for now. Seth Freeman, CEO and CIO at EM Capital Management, joins us now. Good evening, Seth. It's good to have you on the show. Let's start off with what your call is as far as the September rate move is concerned. And do you think that the timing of the elections also has a part to play in this expectation ebbing, apart from the recent commentary and the jobs data that we've got in the month of August?
Yeah, I would say, in my opinion, the upcoming election, other than Donald Trump's conspiracy theory that for some reason the Fed chair is manipulating interest rates to help Hillary Clinton. Absent that theory, I don't think the election has anything to do with what the Fed will decide to do. What I don't expect the Fed to increase rates, announce an increase in rates, but I do expect the Fed to provide even greater clarity and direction to the markets about where they might be heading for the next meeting.
Right. Seth, the Fed had constituted and created something that's called a Federal Reserve Labor Market Conditions Index for a more broader measure as opposed to a very narrow measure of the unemployment rate in and as of itself. Now, evidence has suggested that the LMCI, that index, has declined for 5 consecutive months in the run-up to May. And in August, presumably it has even worsened further. So, if anything, that index that has been constituted by the Fed signals a divergence from, even if the economy is operating at full economy, a divergence from the goal of a lower employment rate. What's your view on that? And is the relevance of that index diminishing? How does it stand?
No, it's very important that you raise this issue, because the headline numbers that we get about the lower unemployment rate, as is now well known, does not reflect folks who have left the job market, who have left the job market for a variety of reasons. In particular, have become frustrated in trying to find a decent job. And so they're no longer counted as being unemployed. Also, just about, I think there's a lag time of about 60 days. Headline numbers tend to be revised once better data comes in to the Department of Labor. And we don't really get much news about those adjustments, but in general, the numbers have been less rosy after they've been adjusted. So it's a very important point, and certainly the Fed, the FOMC, looks at the detail behind the headline numbers in making their decisions.
Right. Seth, let's also talk about what many economists argue, and against what the Fed's argument is right now, is about the Phillips Curve. That's the inverse relationship, of course, between unemployment rate as well as inflation. Now, given the evidence that we saw in the 70s, where there was high inflation rate and that coincided with a high level of unemployment, and in the 90s, a low level of inflation coincided with low levels of unemployment, what is the very strong belief that these two aggregates will move in divergent ways at this point? Because pretty much that's still not happening at the rate at which it is desired, at a long-term inflation target of 2% and a lowered rate of unemployment or new jobs creation at a pacier clip.
Well, certainly inflation is gaining at a much slower pace, at a very anemic level, than we would normally see after this length of time and an economic improvement. On the other hand, we're getting some peripheral indications that this might be on the horizon. There was an announcement, I guess, seems like the beginning of last week, about a sudden recalculation indicating about a 5% average gain in incomes in many parts of the country. And so that would indicate a potentially inflationary environment when wages go up. But it doesn't really tell the whole story, again, because we later found out that most of the gains in income were at the lower jobs, lower tiers of our economy, not in our relatively large middle class. However, I think that inflation has partly been kept under check as a result of oil and the fact that even though consumption is up in general, Americans are still not consuming as much stuff as we did before the recession.
Let's also speak about the quality of growth in terms of jobs that we've seen. I mean, there are definitely other aggregates apart from the headline number itself. So we've got the hourly wages, the split between the private sector job creation as well as the government sector job creation, and also something like the wage growth, how that has panned out, or how that is likely to go through. Seth, I was asking you about the quality of the jobs data. I mean, even in Janet Yellen's testimony, she's been questioned by senators about whether jobs growth, at the number of jobs growth and the unemployment rate is one issue, but the quality of jobs growth. What are the levels? What is the hierarchy of this jobs creation? Is it more of private sector job creation or government sector job creation? Which one of this is slackening? The hours put in and the hourly wages also. A view on that as well, qualitatively dissecting the number.
Well, we have to look at that. It is very important to segment and especially stratify the ranks of employment here in the U.S. And that goes back to my comment about, again, these headline numbers about a sudden calculation of a 5% growth in incomes. But this was really at the absolute lowest levels, not across the board, and not evenly across the country. Either. You know, there are record numbers. I think 150 Chapter 11s were filed. Chapter 11 is a restructuring bankruptcy in the oil and gas sector. So 150 different oil and gas producers and services companies have filed for bankruptcy, representing thousands and thousands of employees, particularly in the greater Texas area. And a lot of these jobs are moderately skilled jobs. They're not necessarily office jobs or programmers and so forth. We had some statistics recently where actually employment in the San Francisco area dropped slightly, in spite of the fact that the technology business remains very strong and there's a huge demand for programmers. So it's very, very scattered. You can't really characterize the situation evenly across the country.
Right. Let's talk about the possibility and when a greater probability of a hike can actually be assigned to. What's your call about December, the quantum of that rate hike? Because over the last year, we've fallen from 4 rate hikes and the prospects of 4 rate hikes in this year to now almost only 1, possibly at the end of this year. Take us through your expectation. When will that happen? And do you think that the delay that has been caused will take away from the effects that are intended to take place?
It's likely for a variety of reasons that the Fed will increase rates by the end of the year. I think partly the Fed has to demonstrate at a certain point that it's, in essence, sort of gaining control over the situation. And on the other hand, I believe any increases will be quite gradual, and that 25 basis points, one way or the other, should not have a grave impact on the economy or economic growth. It's just not that much. It's easy with some anticipation for that kind of an increase to be built into market expectations and other returns. It's just not a big number. I think of greater concern might be the situation in Europe and the fact that the impact of the election of all of this is the fact that I think we're going to see essentially a lack of policy making until after the election. And one of the problems that the central banks have globally, not just here in the United States, is that the range of tools that are available to make adjustments after such a prolonged low interest rate environment is very limited. There's not a whole lot more left to stimulate these economies. The result is that policymakers, elected officials are going to be forced to make tough political decisions in terms of fiscal policy, tax policy, and other types of reforms. that are necessary to get the economy going. The politicians have been able to basically ignore, frankly, in my opinion, their responsibility to set policy. And they've really put a lot of pressure on the central banks to make up for the lack of political courage.